T is John A.G. here, and if you care about real market signals, stay with me because what unfolded this weekend changes how smart money sees silver. Before we begin, go to the comments and type currency archive so I know this analysis is reaching people seeking unfiltered data, not mainstream narratives. What happened between late Friday and early Saturday forced institutions, traders, and physical buyers to reassess risk, liquidity, and the true availability of deliverable silver worldwide. Today, we cover 4 critical developments shaping silver's trajectory into March, each largely ignored by mainstream financial media, yet essential for understanding the structural forces driving price. First, the weekly close signaled a technical continuation pattern that suggests momentum remains intact despite volatility, engineered through margin hikes and sudden liquidity contractions earlier this month. Second, the latest commitments of traders report reveals positioning so structurally bullish that it contradicts the bubble narrative repeated across financial television and widely circulated analyst notes. Third, a multi-billion-dollar streaming deal confirms institutional expectations for long-term silver scarcity, offering clearer insight into future pricing assumptions than speculative forecasts or promotional targets ever could. Fourth, escalating geopolitical tensions introduced a risk premium while exchanges were closed, forcing markets to reprice simultaneously for conflict, inflation pressure, and tightening physical metal supply. Let us begin with the weekly candle, because charts communicate collective psychology, and this week's formation reflects resilience rather than exhaustion following February's forced liquidation event. Silver opened near recent support, absorbed early selling pressure, and closed significantly higher, forming a bullish continuation structure that technical traders interpret as confirmation of underlying demand strength. A multi-day advance culminating in a strong Friday close signals. Institutional accumulation rather than speculative excess, particularly when accompanied by declining open interest across futures markets. Open interest falling, while price rises, typically indicates physical demand, replacing leveraged speculation, suggesting participants are exiting paper exposure while others secure deliverable metal for industrial or strategic reserves. This behavior contradicts narratives describing the rally as purely speculative, because speculative bubbles normally expand open interest alongside price as momentum traders increase leverage exposure aggressively. Instead, we observe contraction in paper positions, implying a transition from derivative-driven pricing toward physical market realities, where supply constraints and delivery requirements dictate marginal pricing dynamics. The gold-silver ratio compressed during the week, indicating silver outperformance, which historically occurs when physical tightness accelerates or when industrial demand strengthens relative to monetary demand. Given current delivery data and refinery backlogs, the physical explanation aligns more closely with observable evidence than speculative inflows seeking high beta exposure to precious metals. Now consider the recovery from February's margin-induced crash, where forced liquidation drove prices sharply lower before structural buyers re-entered, producing a rapid V-shaped rebound rarely seen in broken markets. Such recoveries occur when price declines remove weak hands, while long-term buyers with knowledge of supply constraints accumulate aggressively at levels they consider fundamentally undervalued. Key resistance remains near psychologically significant round numbers, while support established during the forced sell-off now represents zones where industrial users previously demonstrated willingness to secure physical supply. Every major technical framework currently aligns toward continuation, shifting the central question from direction to timing and identifying catalysts capable of accelerating or temporarily delaying the upward trajectory. This brings us to the commitments of Traders Report, widely misinterpreted, despite offering one of the clearest windows into institutional behavior and the evolving structure of the silver futures market. Managed money positions remain historically low relative to price, indicating hedge funds have not yet fully committed capital to the rally, despite silver trading dramatically higher than previous cycles. In speculative bubbles, leveraged funds expand long exposure alongside price increases, yet current data shows cautious positioning, suggesting skepticism rather than euphoric participation among momentum-driven participants. This divergence creates latent fuel for future advances, because re-entry by underweight funds into a physically constrained market could amplify price moves through forced competition for limited deliverable supply. Commercial participants, historically dominant on the short side, continue reducing structural shorts, behavior inconsistent with confidence in suppressing prices and more aligned with risk management amid tightening inventories. When traditional short sellers retreat while physical demand rises, the resulting imbalance can accelerate price discovery as fewer entities remain willing or able to absorb persistent buying pressure. Retail traders increased activity modestly, yet delivery data suggests institutions are acquiring physical metal while distributing paper exposure, reversing the typical late cycle pattern observed in previous commodity rallies. This inversion indicates informed participants prioritize tangible supply security over derivative exposure, reinforcing the thesis that silver's pricing mechanism is migrating from paper leverage toward physical availability constraints. Now consider the recent multi-billion-dollar streaming agreement, which effectively allows the purchaser to secure long-term silver output at predetermined costs far below prevailing market prices. Streaming deals represent sophisticated capital allocation decisions based on decades-long modeling of supply, demand, extraction costs, and macroeconomic trends affecting currency valuation and industrial consumption. Companies do not commit billions to secure future production unless internal projections indicate substantial long-term price appreciation relative to contracted purchase costs and financing obligations. Reverse engineering. Such agreements suggests institutional expectations for sustained elevated prices, not temporary spikes, reinforcing the narrative of structural scarcity rather than cyclical commodity volatility. Simultaneously, mergers and royalty acquisitions across the sector signal consolidation efforts designed to secure supply chains amid declining ore grades, geopolitical risks, and rising energy costs affecting extraction economics. Primary producers face operational challenges, including permitting delays, security concerns, and infrastructure constraints, all of which limit the industry's ability to respond quickly to sustained increases in demand. Even brief disruptions at individual mines can compound into meaningful supply deficits when global production operates with limited redundancy and growing dependence on byproduct output from base metal operations. Industrial demand continues expanding through electrification, renewable energy infrastructure, and advanced electronics, sectors that require silver's unmatched conductivity and cannot easily substitute alternative materials without performance losses. At the same time, investment demand persists as currency debasement concerns drive allocation toward tangible assets perceived as stores of value during periods of monetary expansion and fiscal instability. Geopolitical tensions introduced this weekend add another layer of uncertainty, historically associated with safe haven flows into precious metals and increased volatility across currency and energy markets. When conflict risk intersects with inflationary pressures and constrained supply chains, commodities often experience repricing as markets incorporate risk premiums and reassess long-term availability assumptions. Energy markets play a critical role because rising oil prices increase mining and transportation costs, tightening margins and potentially restricting output, while simultaneously elevating inflation expectations globally. Higher inflation expectations reduce real yields. Historically, a supportive environment for precious metals as investors seek assets capable of preserving purchasing power during currency depreciation cycles. The convergence of geopolitical risk, inflationary pressure, and supply constraints creates a macroeconomic backdrop rarely aligned so strongly in favor of tangible assets within the commodities complex. Copper's strength, alongside silver, reinforces the industrial demand narrative, indicating broad-based repricing across metals essential to electrification and infrastructure development rather than isolated speculative flows. When multiple metals rise concurrently, the denominator, fiat currency purchasing power, is often adjusting downward, reflecting systemic monetary expansion rather than commodity-specific supply disruptions alone. Cryptocurrency weakness during the same period suggests a rotation toward traditional hard assets, indicating institutional preference for historically proven stores of value amid heightened geopolitical and monetary uncertainty. Retail coin sales and mint shortages further demonstrate grassroots demand, with premiums expanding as fabrication capacity struggles to meet simultaneous investment and industrial requirements. Expanding exchange for physical spreads and elevated lease rates signal stress within the physical market, reflecting increased urgency among participants seeking immediate access to deliverable metal rather than future promises. ETF inflows represent another channel through which investment demand removes physical supply from circulation, particularly when funds allocate metal into structures that restrict lending or rehypothecation. Each ounce transferred into long-term holdings reduces available float, amplifying sensitivity to incremental demand and increasing the potential for price volatility during supply disruptions. Meanwhile, regulatory uncertainty introduces additional complexity, as potential structural changes to oversight bodies could alter enforcement priorities and market transparency during periods of elevated stress. Market participants must therefore navigate not only supply-demand dynamics, but also evolving regulatory frameworks that may influence reporting standards, position limits, and investigation of market irregularities. Historical precedents show precious metals often respond swiftly to geopolitical shocks, with silver typically exhibiting higher volatility due to its dual role as industrial input and monetary asset. However, today's environment differs due to already elevated prices and documented physical tightness, limiting downside flexibility and increasing sensitivity to incremental demand or supply disruptions. Industrial users lacking viable substitutes cannot delay procurement indefinitely, forcing purchases even at elevated prices when inventories approach critical operational thresholds. This inelastic demand characteristic distinguishes silver from purely speculative assets and underpins the structural support observed during recent volatility episodes. Institutional accumulation, evidenced through delivery data and long-term supply agreements, suggests strategic positioning rather than opportunistic trading, reinforcing expectations for sustained demand beyond short-term market cycles. As March approaches, delivery obligations and inventory levels will provide critical insight into whether current tightness represents temporary imbalance or a deeper structural deficit. If physical demand continues exceeding available supply, pricing mechanisms may increasingly reflect scarcity premiums rather than paper market leverage, altering traditional valuation frameworks. Investors should monitor open interest trends, delivery volumes, lease rates, and industrial consumption indicators to assess whether structural conditions continue tightening in coming weeks. The convergence of technical strength, institutional positioning, geopolitical risk, and supply constraints forms a mosaic pointing toward continued volatility with an upward bias under current conditions. However, markets remain dynamic, and unexpected policy decisions, currency interventions, or demand shifts could alter trajectories, underscoring the importance of adaptive risk management strategies. Understanding these forces allows participants to interpret price movements not as isolated events, but as reflections of deeper structural changes within global monetary and industrial systems. The narrative unfolding is not solely about silver. It reflects broader tensions between physical scarcity and financial abstraction across modern commodity markets. As always, independent verification and critical thinking remain essential, because narratives, whether bullish or bearish, must ultimately align with observable data and measurable supply-demand realities. If this analysis added clarity to your understanding, consider subscribing, sharing your perspective, and returning for updates as markets digest evolving geopolitical developments and delivery data. March contains numerous delivery days and potential catalysts, ensuring the story remains fluid as participants respond to new information and shifting macroeconomic conditions. Stay focused, stay informed, and remember that in markets defined by leverage and scarcity, the difference between perception and reality often determines price. The divergence between mainstream narratives and physical data continues widening, reinforcing the need for independent analysis grounded in verifiable metrics rather than sentiment-driven commentary. As new data emerges, we will continue examining whether structural forces support current trends or signal transitions, requiring reassessment of prevailing market assumptions. Until then, monitor inventory reports, geopolitical developments, and institutional positioning, because the interplay among these factors will shape silver's trajectory more than short-term speculative flows. Thank you for watching, and remember to type currency archive if you value data-driven analysis over sanitized narratives designed to comfort rather than inform serious market participants. We will reconvene after the next major data release to evaluate whether physical demand, institutional flows, and geopolitical developments continue reinforcing the structural thesis outlined in today's discussion. Markets reward preparation and punish complacency, so remain vigilant, question assumptions, and prioritize evidence as we navigate an increasingly complex and rapidly evolving global financial landscape. This story is not of art, it is accelerating, and those paying attention to physical realities rather than headlines will be best positioned to understand what comes next.